The third quarter of 2022 continued to present challenges to investors. These have been the same challenges that we've seen all year. That is, higher inflation being dealt with by the central banks via higher interest rates. This has created volatility not only in the fixed income markets, but also the equity markets. The Bank of Canada, for example, raised its overnight rate to 3.25%, while the Federal Reserve raised the federal funds rate also to 3.25% in September. The volatility that we've seen in the equity markets wasn't uniform across the quarter. In July and August, we actually saw a rally across equity markets, not only in the United States and Canada, but around the world. But that gave way to typical seasonality in September, with September normally being the weakest month of the year. True to form, we saw increased downside volatility in September, wiping out much of the gains that we had earlier in the quarter. From the economic perspective, the data released in the third quarter suggests that the risk of recession have moved up, both in Canada and the United States. In particular, in the United States, we continued to see the manufacturing output weaken, housing starts at a slower pace than what we had at the beginning of the year, and leading economic indicators negative. In addition to the inverted yield curve, these indicators suggest that risk of recession are at 50% or perhaps better over the coming 12 months. In Canada as well, we've seen a softening of the labor market over the last 3 months. Now, in general, we believe that the risk of recession is more likely to be a little r as opposed to a big R. And what that means is a minor contraction in economic output as opposed to a deeper recession like we saw in 2008 and 2009. Some of the indicators that suggest this is that we're starting to see inflation actually soften. Our indicators for inflation tell us that in a year's time, it's going to be much lower, both in Canada and the United States, than where it stands today, which will allow the central banks to ease off on their very aggressive increases in interest rates. When we put this all together, we are actually more optimistic on the equity and fixed income markets in the coming 12 months than the economy. That is because equity markets are a forward-looking mechanism. That is, they tend to discount forward risks. So we think a lot of the downside that we've seen in 2022 has already priced in a lot of the risk yet to come. For example, the TSX has only been cheaper 4 times since 1995. And in each of these time periods, we've seen a significant rally of greater than 20% in the coming year. So when we look across the equity markets, we see better valuation than we have had through much of this year, and therefore better opportunity in the coming 12 months. From the fixed income perspective, bond yields are at levels that we haven't seen in some cases 15 years. We believe bonds are returning to their defensive posture within client portfolios. Overall, while there may still be short-term volatility, we remain optimistic on the markets for the coming year.